Good evening. This is the Eye of the Storm podcast with the big picture outlook for the NASDAQ 100 on Sunday, July 3rd, 2024. First, I hope everyone is having and enjoying their holiday weekend. And in several parts of the country, I'm sure it's very sunny and warm. And in other parts of the country, they may be suffering under some storms. So I hope everyone is remaining safe, but is relaxing and enjoying themselves. As I said, I wanted to take a look at the big picture and update that and take into consideration where we are in the correction process, what we know thus far, and et cetera, et cetera. But I want to start by giving a little bit of a background into what I feel is a question that's being asked by many people. And so this came to me via a subscriber on YouTube, and I found it to be a really great question and an important one in which to take a look at, just to bring some clarity and some understanding around basically what we're confronting here in the markets right now. So that they come out and said that they find it very hard to understand how a $45+ trillion exodus from equities markets is supposed to happen. And I basically started by saying that I wasn't sure how we arrived at that 45 trillion plus number that would be leaving the markets. But I leave open the possibility or the chance to do the same math to figure how much money left the markets in 3 short weeks back in March of 2020 and February to March of 2020. And that also what we needed to take a look at is how much of that money was put back into the market, again, via newly printed, newly created money, quantitative easing, basically times infinity, because they just kept pushing it until they drove the interest rates nearly down to zero. So, and that also took place over 2 years, 2020 to 2022, and here we sit. So this might be the more difficult part, but I wanted to suggest or attempt to estimate how much of the gains over the last 2 years were due to just truly over-evaluation and hopes for continued extreme pace for the run-up to grabbing that gold ring. So irrational exuberance, in my opinion, for sure, takes partial, if not most of the blame for all that's kind of going on in the markets. And also I want to consider what happened back in 2000 to 2003 on the buildup to and the knockdown from the dot-com bust. And then so we had this huge buildup of what took place back then was you basically, and I was there, folks, I was on the trading floor. I witnessed a lot about companies that did not have .com in their corporate name. And one company, for the life of me now, I can't remember. Broadcom is what comes to mind, but I do not believe it was Broadcom. But they put .com after their corporate name. And the stock went up $100 the next day, $100. So that was the type of craziness we saw. We saw that again to the tune of Apple Computer and Google and Amazon and Facebook, all of them, Adobe, Microsoft, et cetera, just racing for the stars. We saw this. And now that it's starting to come off of that, I need to go back and take a look at, well, what happened here in basically 2 years? The market lost 82% of its value from 2000, March of 2000 to October of 2002. So what does, when we take a look at these things and we put them together, it also helps to put into perspective, what can we expect from here? Now, one thing I want to add to this is that the latest inflation numbers that we had is that it's at 8.6%, which is the highest that it's been in 40 years. If we go back 40 years, we're at 1982. We just take it back a little further. We're now at that era, the last era where the interest rates and inflation, not interest rates, but inflation was as high as it is today. If I go back and I look, well, it actually was also the time when the interest rates went to 21% in the Fed funds, and that was in 1981, when the yield topped and the price of bonds bottomed. And now we've seen the total reverse. We've seen it go from the high to the low as far as yields. So rates topped, prices bottomed. Now we've seen yields or rates bottom and the price of the bond top. Now, just technically, you've got a lot of correction to go. Again, same deal. So that's why I'm looking at 20 years here. This is the low in 82. This is the high in 2022. And excuse me, in 2002 to 2022. So I'm looking at 20 years. And that's the cycle that's going along with the interest rates. So now I'm putting my picture together about what could affect the market and where can we go if we happen to follow that same trajectory, that same pattern, that same process. So trying to understand what could cause the market to just really continue to drop would be put into your factor. What if inflation really is out of control? And what the Fed is saying that we hope to have it back under control in 2 years may be truth, but that doesn't mean that interest rates aren't going to go from where they are up to 9 or 10 or 12% or higher in order to achieve that goal. So, but to say all of that would rattle the markets. So you don't want to scare this money, because when it goes out, it again will have an effect on corporate America, which will have an effect on everything, right? So put your picture together to understand what needs to kind of start to relax and get into a little bit of a repricing schedule. You hear me talking about that. Things need to be repriced, and you're seeing it on a corporate, tightened corporate level. Mark Zuckerberg came out over the weekend and or the end of last week and started talking about, well, we're probably not going to hit our targets for how many people we're going to hire. In fact, they're offering the door. They're offering, resignation to many who might not like what's going to be happening. So that is mega firm Facebook, which grew up, by the way, during this entire go crazy period. This was courtesy of Facebook, of Google, of Silicon Valley. So was this, but this was the recovery and just the rebuild. And Google didn't go out of business, Apple didn't go out of business, Microsoft didn't go out of business, but they recovered, and they recovered very, very nicely. And they split. So there was more stock and more hand, more generation of wealth. And now it's like, well, you better take some of it because it's going to be redistributed. So again, based on what everything's happened, everything just moves in a cycle, folks. So it just kind of really does just kind of go. So what I need to also add with all of this, and I know this is kind of my opinion, but this is a podcast and I'm the star today. So add to this that if an Elliott Wave analyst does not have a crystal ball to tell any of the who, what, where, when, or hows of what a market is or is not going to do. And I believe very strongly that neither can the Fed chair. They don't have a crystal ball either. So my opinion on the Fed is that they have been using kind of a flawed model for years to attempt to predict economic conditions. So I don't see how Chairman Powell or the Fed as a group can model the future when there's so much uncertainty. And here's what I think is really kind of key to all of this thought process. And I believe that the status quo has been shattered and destroyed primarily by the global pandemic. So all that has taken place here in the United States is not our problem alone. It's a global problem, and it continues to get aggravated by the geopolitical disruptions occurring around the world. So right now we got Russia and Ukraine. What is that disrupting? The biggest things is disrupted, are the flow and the shipment of commodities, of grains, of wheat, and so on and so forth. The number one was coming in and out of the Ukraine. Not anymore. You have disruptions in the supply chain. They're continuing. Those aren't over yet. So how's that going to affect? It all has an effect. We got a lot of money sitting in there waiting for that to happen. It's not going to happen. Well, I can't buy it. Well, if you don't buy it, guess who doesn't make money? Flow, flow, flow. Eventually it's been flowing down. Now it's going to flow back up. They're not getting it. So all of those things start to come into place. Things begin to stall. Real estate begins to stall. Why? It's costing more to borrow the money to build it. It's costing more to borrow the money to buy it. Right now, that's going to start knocking people out of the picture. So, and then I'm just going to include that, I think that when we have a government and court system that tends to kind of like, okay, we're going to stick to what we believe is constitutionally correct, and that's their job. But I'm thinking, what Supreme Court, I don't know, you're being a little bit short-sighted here. And siding against climate change, which is a serious problem, in favor of, you guessed it, money. So I think once we put that all together and we have a view again of those numbers that have already taken place in the comparison, and then we put the thoughts in, it could become just a little bit clearer how possibly $45 trillion could just go poof, disappear, be removed. So remember, when you say, well, I just don't see how that could happen, I could only tell you that, and I'm old enough, folks, so listening to my grandparents tell me about what they saw in 1929, 30, 31. What they saw. Did they see prior to that? Did they see that what was coming was a global depression? No jobs, no money, global suffering. Did they see it? I have yet to find a yes answer. My own grandparents would definitely no. So I also don't think that people have actually seen the damage or the seriousness of this COVID pandemic. And I don't think many still don't see it, but that's okay because it still happened. And it did shut down the world basically for 2 years. So how we recover from all of this is first to recognize and adjust to the inability to return to normal, and I'm going to throw quotes around that, as it was prior to COVID's arrival. So this recovery from the damage created by COVID and other geopolitical situations in the globe, it's just begun. But it's by no means is it anywhere near producing a widespread recovery right now. It's just not there and it's not ready. So what can I do to provide? I have all of that standing behind me, but I can only really approach this market on a day-to-day basis. I'm giving you a big picture just so that I know there are a lot of people out there that trade longer term, mid-term, more swing trade. And so I'm just putting out as much information. We all need to draw our own conclusions and then choose which we may find are the best instruments for us to trade, where to put the money, et cetera, et cetera. So each one of those is a different conversation. But right now, my focus will remain in trading without bias. So you can do that with a long-term view, with all-term views. Because if you're just looking to set up trades on a very long-term basis that will be able to be surviving large swings in either direction, then you're going to be looking at more about how they're affected according to interest rates. Because that's actually, like I've said all along, sits at the top of our food chain, our pecking order, et cetera, is interest rates. How much does money cost? And then how much is available? Right now, with the higher interest rates, it's going to be less available. And that's going to have its own effect. So technically is how I'm going to approach this market. And technically, I have to remain without bias. I don't want to be bullish. I don't want to be bearish. Not when I'm just trying to figure out if the market's going to go from 11,600 to 11,800. So that's how short I've got my picture. Back to the long-term picture. What I believe as a minimum of what I'm now looking at, at first I was looking at on the intermediate degree, and I'm going to pull this down, take a look at it on a much shorter, oh, we're opening, okie dokie, basically unchanged. I'm looking at the charts now on just regular monthly, and I am looking at the primary degree now putting in its A wave. So within that, I have to be able to count an ABC of intermediate degree. So, but on this larger picture, what becomes available? Go back to that maximum just for a moment. I've already said that this drop was 82%. That's with the NASDAQ lost 82% of its value, high to low. And here we have this magnificent rally phase that was 22 years or at least 21 years in the making. And now we're at the crest and the turn of all of that. What can we expect? Again, Elliott does not pretend to know why or how. It is just purely technical analysis based on the wave principle and how these patterns do repeat themselves because they're humanly created and it's human emotions. So toss that all around. Euphoria, everything's great, everything's wonderful. Oh my God, no, it's not. Oh, yes, it is. That's still going to go on, but right now we're kind of in this downturn. We're kind of in this other important factors, interest rates. That's what's creating it. That's what will continue to keep a grip on it. And that could last for another 2 years, just like the Fed is predicting. So Elliott also tells me that fourth waves, of any degree, will normally find their terminus, their endpoint, within the price of the fourth wave of one lesser degree. And quite often, I think Elliott was talking about the terminus, that he found it that it normally would go to the end point of the fourth wave of one lesser degree. I have found over my years that it's actually within the price structure, the price range of that previous fourth. And you could go to the lower sides of it. Now, if I just I'm looking for this big correction. If I felt that this drop would be in any way related to this drop, because this was all over-evaluation and this was super over-evaluation, which is why I talk about that I think we should at least, as an absolute minimum, come down to that level. That takes care of the last 2 years of over-evaluation. Well, don't forget, we were in a pandemic. And the only way we could get ourselves out of it was to create and pay out huge amounts of money so that we can all continue to buy groceries, so that we all can continue to live. Then when they started to lift the restrictions, people could get back to work, and they weren't, then the tables turned because we no longer could hold things at those levels. Something had to give, interest rates. We're not lending out money that cheap anymore because people were now using it to just live. And wage inflation takes over, et cetera, et cetera, et cetera. So here we are. And if I figured that this could have any play and picture into what happens now on a super cycle degree fourth wave compared to the cycle 4, then even if it comes in at 82%, And that would suggest 82% drop off of 16,768. That's the all-time high. And that suggests that we could have a drop. 82% is about 13,750 points. So it basically can take us back to 3,020. Now that's not even down to the bottom, which is at 806. That basically starts to put us up here. Now, if we come down in wave A to 6,900, even getting as low as 6,630, then I would say here is pretty comfortable. Still above on the monthly chart, the 200 moving average, the EMA, and also the 200 SMA on this monthly chart. Then we get a B wave. And that would be a primary. So what I'm continuing to count down is here we get through this. We're still, now I'm going to start to take this down because I can pull it into today. So if we're looking at a likelihood that, first of all, we're going to come down to here, which is taking care of all of this over evaluation, then we'll rally again, reinflating many of our most popular trades. And those are going to come, folks, right from the likes of Apple, Amazon, Google, all of them, Meta, Microsoft, et cetera, et cetera, et cetera. This isn't going away overnight. It's going to take time. Remember what I've also said, 10 to 12 years. If we're just starting to correct this 2-year period, what comes after that? We get a B wave, and then we get a very destructive C wave, and then we're likely going to be finishing it up with the other balance. And if we're only going to go down to 3,000-ish, we're down to here. We're inside that fourth, and we're down to here. And that could be that cycle 4. Then we turn and we start to go again. So again, 2 things. I will sit, and because I have memories of, gee, I was trading this. It was tradable. It moved. Lots of money was made, lots of money was lost. I will tell you that. But that same, and this, folks, was 2008, 2009 in the NASDAQ. Cycle 4 on the dot-com bust, primary 2 on an economic collapse. Wow, that's pretty cool. But here it is. So 3,000 is a target that I'm putting on there. And I will continue to monitor because I am a member of society. I do sit and I know what the interest rates are doing. I know what I hear in the news. I do keep up with things. So that part's going to continue. But I do believe that's our long-term picture. But now I want to just take it down to more of a month by month, maybe, or we can look at a weekly. The weekly chart continues to show that, again, we're all the way down. Hopefully we're all in agreement that that is the high. That's the ultimate high for right now until we do a super cycle completion of a correction of an ABC. And that has to be an ABC on intermediate degree, primary degree, cycle degree. And then again, that'll finish the one all the way up to super cycle. So we're on our way. And we got a lot of points to go into this. So right now, I am tending to feel that this remains a minor wave 1. And we have a minor wave 2 that could still be in motion. If it is a minor wave 1 and this ends up being a minor wave 2, I'm going to take this down to the daily and let's just take a look at what could come about. Again, I'm going to run extensions and I'm going to run them down from the top of where this minor wave 1 began to the bottom and then to the top that we have thus far. So we're going up from this high, which is at 15,305 down to the low at 11,068 up to the high at 12,262. And that needs to be changed just a little bit. 262, thank you. And that'll finish that. Pull that in, now we're better. So now we can start to see if this truly did complete the minor wave 2, then what we're looking for is a pretty sharp, quick, massive drop lower. Kind of like market dump. People are going to get out. Firms are getting out. Whatever the reason is, whatever's going on, it's creating that type of a situation where we're just going to get out. And so that would be next. First support, 11,256. Then we have 11,068. And I think this should go quick. If indeed that's going to be our 12,262 is our top, then I think the market will start to accelerate and start to fall much quicker. All right, then we have 16,635-ish. So we got 530 down to 630. And no, that's not. Let me see where this zone is. This guy's at 693 down to 630, excuse me. So about a 60-point little support zone there. Then it breaks. Then we're down to 10,131. So once we get below 11,068, which will be support, don't know how strong, then we're headed down here, 10,006. Then we're heading down to 10,001. Now there's some that, and there were other different Fibonacci numbers that I have used that showed 10,500. Those will remain because I believe that those Fibonacci's will be there. I'm now running them a little bit differently. So they maybe are still connecting this to here and they're running the whole C wave, which I can do as well. So there's different layers that we can add that still remain valid. And I'll show you. So even if I'm just running still from that same level, let me get in there and fix this. This high is 15,305. And say, okay. And this is. All right, so. Yes, 12,068. Sorry about that, folks. I just want to make sure I've got things a little bit accurate. Middle point. 12,979. Got it. Now I've got some accuracy. Okay. So we'll add a layer now coming off to both a C wave and then just a larger C wave. So we have these inside, all the way inside. These are support levels well. We have another layer up here at 10,600. Then we have a layer of 10,133 down to 10,068. So 100 points in between this low and this low. Then we have 9628, 9258, etc., all the way down. And we're dropping, you can see here. So eventually, I think we get 1, 2, and then the 3, and we do end up down in here, where 3 would be equal to 1 at 8,000. So maybe we get down into here, we rally when we come off again and come down into here and finish the C wave. So we do have room to go. And that would be, there's a lot of different choices if you're looking to do a position that's going to benefit you during that drop. There's options in the NQ, which I don't necessarily like to trade, but there's options across the board and a lot of other things that you could reflect it. Stocks will participate, they have to, if the market's being sold. And some of the biggest ones are going to participate, whether they're doing it willingly or not, they're going to go. And they may be more volatile, but I think I would be looking at Apple. I'd be looking at Amazon. I'd be looking at Google. Google's going to split in July 15th. I would wait. Meta, Microsoft, et cetera. There are things that can be done in those stocks, option wise, that you're going to basically look at that chart, where figure out your levels, and then you can just put on spreads that would benefit on that way down. Trading the future, I personally would going to keep it on a day-to-day basis. There will be times when it's going to be pretty dynamic. But I don't like to leave. I would not leave a position in the future on, because I think that the volatility will dictate that you don't, at least unhedged. But I do think that we have more downside. Now, on the flip side of that coin, and I would be remiss if I did not include it, the market hasn't broken below 11,256, and it needs to do that to kind of put into place the strength and the possibility that this is 2, and this is 1, and this is going to be a 2. So I'm thinking if we can get ourselves back up here, that would make a clean. This could be 1 of 3, 2 of 3, 3 of 3. So if not, and we just start to go from here, again, we're closed tomorrow. US is closed, but Globex is open now. Globex will remain open until 1 Eastern tomorrow. And then we reopen at 6 Eastern tomorrow. And that goes until our opening and when we join the party. So there will be trading. If it breaks down from here and it starts to go below these moving averages, these hourly moving averages, the 50, it hasn't gotten up. And again, we continue to have this resistance up here with the 200 SMA and the 200 EMA crossing over and forming a Venus flytrap, it almost seems. Come on, get in there, and boom, it gets closed, and this just drops like a stone. In any case, I don't want to get into that one because I'll be doing another update tomorrow to cover that after our opening tomorrow in Globex, and we'll take it from there. In the meantime, I'm going to drop this off right here. I hope I've tried to clear up some of these a little bit connections between the big picture and reality, and then the daily picture and reality as I see it. And the next update will be just the regular Elliott Wave update, and that will be tomorrow on July 4th.